Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to this webinar on choosing tax-efficient vehicles. Some of you may or have heard a similar webinar that I gave last sort of September. This one really follows the same line as that one, but with an update as to what sort of happened since last September up until now, because of course we have had another budget in that time. So just coming on to the contents then really of what we're going to cover today. We're going to look at spend a bit of time looking at income tax on employer-provided vehicles. We'll also look at whether it's worthwhile really for your employer to provide fuel for non-business, i.e. private motoring, whether that's tax efficient or not. We'll then move away really from the income tax side of things to look at considerations for the business owner. And the main point I want to get across today, which is a point I always make when I'm talking about company cars, employer-provided vehicles, is why it's important to plan ahead. Briefly, we'll touch on salary sacrifice arrangements and how that impacts on employer-provided vehicles. We'll look at pool vehicles, and we'll also look at own car versus private car sort of considerations, i.e. if you're offered a company car, should you take it or should you not take it? And both sides of that. So you're looking at it partly from the income tax aspects as an individual, whether you're a director or an employee, or the other side from the business perspective. First, though, before we get going, I just wanted to ask a question, really, because it's all talking about the sort of direction of travel with the government. So this first question, if you could please answer it now, is just to ask whether you or your business currently run any electric only or hybrid electric vehicles in your fleet or personally. So it's very simple, just a yes or no answer to that, if you could please. And just collecting the results, and it looks like from what we've got here that we're pretty much 50-50 on that actually. So we've got a roughly even mix of businesses or individuals who do already run either an electric car or a hybrid electric vehicle. So that's quite interesting. We'll come to a sort of a similar question sort of looking ahead later on in this webinar. So kicking off then with the income tax position on cars. Basically, as most of you will no doubt be familiar, a taxable benefit arises on an employer-provided car where it's available for private use. And that's pretty wide-ranging, and it's quite hard to sort of circumvent that, but we will look at pool cars and things a little bit later on where you wouldn't get a taxable benefit. But just one of the main reminders about that is if a car is available for ordinary commuting to and from your normal place of work, that is private use, that's not business use. So the actual taxable benefit in kind on what the individual suffers tax on is calculated by reference to the list price of the vehicle plus its accessories. And then it's multiplied by a percentage, which is based upon the carbon dioxide emissions of the vehicle that's in question. So basically, the higher the emissions, the higher the taxable benefit that arises. So currently, the minimum amount is 13%, but it goes up to a maximum benefit in kind of 37% of the list price. And this is an annual benefit in kind. We'll show this with some examples in just a minute. Diesel cars have been, have lower CO2 emissions, but have higher emissions of other types of sort of particulates and things. And they carry, up until April of this year, they typically had a 3% surcharge on their CO2 emission threshold. But actually, this was one of the changes that came out last November when that increased to 4% for vehicles that are sold from April 2018, unless they're RDE2 compliant. And there was some confusion last November, really, when this was announced, because no one actually knew what RDE2 meant. And in fact, the RDE2 standard didn't exist. And it's a different type of test, and it's a real driving emissions test. There's been much sort of publicised, I think, about how the sort of standard miles per gallon tests and the emissions tests don't actually model real driving conditions. And so the real driving emissions test is I think, just that, does what it says on the tin, really. It's based upon actually how a car performs in practice. But I think as we stand today, I've struggled to find exactly where we're up to on all of this. But as far as I'm aware, there aren't really any cars on the market that can claim to be RDE2 compliant at the moment, because it's a new level that's only just really sort of coming in. And I think it's more likely to be sort of 2019 before we actually see cars, diesel cars, that are RDE2 sort of compliant on the market. I think there's RDE1 standard, which is currently available, but RDE2 takes it to a higher, is a stricter test effectively. So as I said, the benefit in kind will be between 13% currently and up to a maximum of 37% of the list price. You can have certain sorts of deductions against the benefit in kind. So if an employee actually makes a capital contribution towards the cost of the car that's being provided to them, that can reduce the list price of that car for the benefit in kind purposes. And indeed, actually, if you make sort of annual payments towards the private use of it, that again can sort of offset the benefit in kind. Don't tend to see that very often in practice, but it might occur in certain circumstances where an employee wants to take a higher vehicle than the company is willing to provide, and makes a contribution towards the cost of that. Reporting of these benefits in kind, of course, is via P11Ds. Most people will be familiar with the benefit in kind reporting, or indeed it can be done through voluntary payrolling. Changes to salary sacrifice rules I'll come on to later. So just to flesh this out then really with an example, or a threefold example of how the benefits in kind sort of actually wash through for three comparable models of the same car. So what I'm looking at here is a Volkswagen Golf, and I always choose sort of fairly sporty cars because that's what I quite like, being a bit of a petrol head. But I've gone for the Golf GTI, which I'm comparing with the Golf GTD, and then also comparing that further with the Golf GTE. So obviously the first one is a petrol car, the second one is the equivalent diesel variant really, and the GTE is our hybrid electric vehicle. So it has an electric motor as well and a battery, as well as having a smaller petrol engine. And you can see there the sort of headline figures really. I mean, all these cars have got a similar sort of list price. They vary by £1,000 or so either side of 30 grand. And the fuel consumption is very different. The CO2 emissions are slightly different. And the benefit in kind that comes from those CO2 emissions is then shown on the bottom of this table. And so this is for 2018-19, i.e. it's the current tax year. So the GTI attracts a benefit in kind of 30%. The GTD is at 28%. Now, obviously its emissions are quite a bit lower, but it's carrying that surcharge. So that's why we come up to 28%. And the GTE, because of its hybrid system, comes in much lower at 38 grams per kilometre of CO2, and that currently attracts 13%, which is the minimum benefit in kind. So actually to say what does that physically cost in terms of tax each year then? So this is, it should say tax liabilities for 18-19, because that's what the actual figures are. But basically the benefit in kind then is 30% of that list price for the Golf GTI. So the actual benefit in kind there comes in at just over £9,000. And you can see that the figures going across then for the GTD and the GTE. But what that actually means in real tax terms, so that's the benefit in kind is the amount of earnings you're treated as having had effectively, on which you then pay tax either at the basic rate or the higher rate, typically depending on how much you earn. So if you're a basic rate taxpayer, you can see that Golf GTI is going to cost you £1,800 odd for this tax year in terms of actual tax suffered on having that benefit. The GTD is not vastly different actually, but the GTE of course is significantly less at £800 odd. If you're a higher rate taxpayer, i.e. you pay tax at 40%, not 20%, then obviously the amounts simply double. But quite a significant difference there between the petrol only variant and the hybrid electric variant of the car. So looking ahead then really, which of course is one of the key points I said I wanted to draw out, is what happens with company car tax is the benefit in kind rates, these percentages are published several years ahead. So we know what's going to happen assuming there's no changes by the government, we know basically what's going to happen in a number of the future tax years. So what I'm looking at here then is effectively trying to model the 3-year period for which, say, a company car might be owned for. So we've already had the 2018-19 figures on the previous slide, so they're just duplicated here. But then what happens when we go to 2019-20, you can see that the emissions thresholds are effectively being tightened up. The car obviously still has the same emissions, but because of that tightening, the benefit in kind percentage therefore goes up. So our GTI jumped up by 3%, and it's the same with our GTD, and actually it's the same with our GTE on this particular one. So all of them see a 3% sort of increase in the value of the benefit in kind, and then of course the tax liabilities that flow from that increase accordingly. So the income tax liabilities, I've just shown them here for a higher rate taxpayer, i.e. somebody earning roughly in the region of £45,000 a year or more, including the value of that benefit in kind, I might add. Obviously there's a bit of an increase then between 18-19 and 19-20, but what's then quite interesting is in 2021 we move into a slightly different sort of tax regime, whereby both the GTI and the GTD still have an increase in the benefit in kind. It's a much smaller increase. We only got up by 1% on each of those, but the GTE actually drops then down to 12%. And the reason for that is because we're moving into some new rules really at this particular point for cars that have an electric range, and we'll talk about that in a bit more detail in just a moment. But the headline, I guess, from that slide really is on the bottom there. If I just compare the GTE with the standard diesel, the tax saving over 3 years is roughly £5,500. So it really is quite a significant amount for what on paper at least is a comparable car. So well worth looking ahead when you're choosing these vehicles. And that of course is just the tax for the employer. There's the business or the company's tax position to look at as well, which will also be more favourable where you've got cars that have much lower CO2 emission threshold. So moving on to the car fuel benefit in kind. So we've talked so far just about the benefit in kind that you get where you're provided with a company car. If you're also provided with fuel for private use, that leads to a further benefit in kind. And the question here really is that worth having, or what are the alternatives? So the fuel benefit in kind is calculated in a similar way, except that we don't do it by reference to a list price this time. We just take a fixed sum that is published by the government each year, and we multiply that by the same percentage benefit in kind that we've used to calculate the value of the car. So the fixed sum for 2018-19 is £23,400. And so for that Golf GTI that we were just considering previously, the benefit in kind of having your employer pay for your private fuel motoring is £23,400 at 30%, which is a further benefit in kind of £7,200, which means that even if you're a basic rate taxpayer, then that's going to cost you £1,400 odd in actual physical income tax. A higher rate taxpayer, of course, it's getting on close to £3,000, the actual tax that you'll pay just for receiving that benefit. So is that worthwhile? Well, I put on the slide there, the answer is normally no, because actually if you work out the miles per gallon that these cars achieve and the number of miles that people typically do privately, in the vast majority of cases, you actually find that the tax that you suffer outweighs is in excess of the cost of the fuel for the private motoring. There are some exceptions to that, obviously. If you do a very, very high private mileage, then maybe it would be worthwhile. And actually, where I sometimes see clients choose to sort of take this benefit is where they can't be bothered to keep records. They just want to put all their fuel through the business. They don't want to track their mileage, so they record their private and their business mileage, and therefore they just take the tax hit because it makes it easy for them. So the alternatives to the car fuel benefit in kind then, if you want to avoid it, basically no fuel can be provided for private use, i.e. The employer should only pay for the business fuel. So there are specific fuel rates that HMRC publish, which are updated from time to time, advisory fuel rates they're called, and they're for use specifically really with company cars. So, and you can use them in two ways. So it can be that literally no fuel is provided, the employee pays for all their own fuel and then claims these advisory fuel rates in respect of the business mileage they do. Or you can turn it the other way around, and the employer could provide all fuel, and then the employee can make good their private mileage to the business using these advisory fuel rates. But it is obviously very important that record keeping is good for that, because technically, even if you've got only a very small amount of private mileage that's being paid for, that car fuel benefit in kind exists. And also one recent change that's just come in is that any making good of private mileage where the employer's paid for some of it or all of it must be done by 6th of July following the end of the tax year. The reason it's 6th of July is that's because that's the deadline for actually preparing and submitting P11Ds to the revenue each year. So that's quite a recent change, and it's just one to be aware of, that effectively if all that private fuel is not made good by the 6th of July, then the car fuel benefit in kind applies. So I said I wanted to look a bit more at electric cars here. And I've, for one, have noticed an awful lot more of these cars on the road. It's the Tesla Model S. I keep seeing them around now. I think 2 or 3 years ago, there weren't any. They're pretty prevalent now. And these are electric-only cars, as most of you are probably aware. And in particular, then, I wanted to look at what's going to happen to the benefit in kind tax rate on these cars. And the reason is because we've got a step change in 2021, which is when some new rules come in, whereby the benefit in kind is going to be assessed partly by reference to how far they can go on an electric-only range. And the Teslas have a supposedly on paper at least, they have quite an extensive range. I think they can travel sort of several hundred miles between being charged. And that means that the benefit in kind is going to reduce massively on these cars by the time we get to 2021. So currently, actually, that car is dealt with the same way as our Golf GTE. So for 18-19, you can see we had that 13%, 19-20, we've got 16%. But come 2021, the benefit in kind percentage for this particular car drops to just 2% because it has a very large electric only range, because it is an electric only car. Whereas the GTE won't compare as favourably because it's a hybrid electric and you know, is still and will only have a limited electric only range. Also, there's obviously no fuel benefit in kind because there is no fuel that's being provided. And announced very recently was that there will be an exemption from any benefit in kind if your employer provides workplace charging for electric cars. So the direction of travel is very clear there. The government wants us to drive clean vehicles, and in particular electric vehicles. And if you do so, you can have what's actually a very expensive car at a very acceptable tax cost. So just on the final sort of point on that slide then is in 2021, because of this 2% benefit in kind rate, a higher rate taxpayer would suffer tax on this car of just £560 per annum. And that's for a £70,000 motor car. So, you know, hugely tax efficient. And obviously you've still got to buy a fairly expensive motor car in this particular example. But obviously I think, you know, more and more models are continually coming to the market that are going to benefit from some of these extremely, that are going to be extremely tax efficient. So that about covers it for cars. And I just wanted to move on to vans next. Vans have a different regime that attaches to them. So we've dealt with cars. Now we're talking about commercial vehicles, much simpler really than the company car rules. We don't have to look at all the different sort of emissions thresholds and all that type of complicated stuff. Basically, if there's insignificant private use for an employer-provided van, then there's no taxable benefit whatsoever. So your white van driver who is given his van, but not really able to use it for any significant private use. I mean, he can go to and from work in it, that's absolutely fine, but shouldn't then be driving it around everywhere at the weekend, say, then he won't suffer any benefit in kind on that. It is, of course, advisable to have a formal use policy if you provide vans to employees, and including sort of signed declarations by the employee that they are aware of the company's rules that about not using the van extensively privately. And some form of monitoring is needed for that as well, because HMRC are known to request and review mileage and tracker records and things, because of course quite a lot of vans nowadays are fitted with trackers. But operated correctly, basically you can give your employees vans to use for business purposes, and they don't suffer any benefit in kind for the insignificant private use or indeed the ordinary commuting that's there. Where that doesn't apply, i.e. where a van benefit in kind does arise because the employee is able to use it extensively or as much as they want privately, then actually ordinarily we just get a flat rate benefit in kind, which is currently £3,350. That's for the current tax year 2018-19. So the tax cost of having that van then for your basic rate taxpayer is £670 per annum, £56 per month, not too significant. There are potentially lower benefit in kind rates for zero emission vans and sort of commercial vehicles, but that is currently being phased out, but still with us for a few more years. There's also a fuel benefit in kind rate for vans, i.e. where the employer's providing all the fuel, say, or some of the fuel for private motoring, and the van benefit in kind applies. So that's £633 is the current benefit in kind for that. Reporting, again, is normally via a P11D. Again, there's the possibility to voluntarily payroll benefits in kind now, i.e. you record all of that through the payroll system rather than the year-end reporting via P11D. At the moment, that still remains voluntary. I'm sure that in time we will see that become mandatory, but I'm not aware that that's in the pipeline just yet. No benefit in kind, nothing to report, obviously, where the van benefit doesn't apply. The question often arises, do I have a car or do I have a van? And in many cases, of course, that's blindingly obvious. But there are some more complex cases, for example, dual cab pickups, certain sorts of luxury off-road vehicles. And in particular, you'll see lots and lots of builders driving around in dual cab pickups, such as that shown in the picture here. And the reason for that is they will typically have chosen a model that qualifies as a van, so gets that much more much lower tax rate that vans have compared to cars. It's quite easy to get this wrong sometimes, but in a nutshell, really, if it's suitable for private use, then it must be primarily designed for carrying goods or burden if it's going to be classified as a van and not a car, because of course, lots of vans are suitable for private use, but what are they primarily designed for? So in relation to our sort of dual or double cab pickups, very often that means they have to have a payload of at least a ton or more. Then they'll often be treated, or typically be treated, as a van. If you've got a luxury 4x4, I'm afraid normally those would be treated as a car and taxed accordingly. But the message really is to check the position before you buy anything, and take advice as needed. So far then, really, we've looked at the income tax position for the recipient of the car or the van, the employee or the director of a company. So now I wanted really to look at it more from a business owner's perspective as to what happens for vehicle ownership. So there's a number of tax-related considerations, which include what deductions do I actually get against the profits of the business, whether that's corporation tax for a company or income tax for an individual running as a sole trader or perhaps through a partnership. When you buy Cars and vans, there's typically VAT on that, of course. Can that be recovered? There's VAT on fuel. Can that be recovered? What are the HMRC reporting obligations as an employer, which we've already kind of talked about. And then also where these benefit in kind arise to the individuals. Okay, we've talked about the fact that the employee will have to pay income tax, but of course the employer actually suffers Class 1A national insurance on the value of those benefits in kind as well. So again, if that benefit in kind is lower, then the Class 1A national insurance cost to the employer will be lower. Other considerations which are not tax driven, obviously the administration burden for a business, it can be quite an important sort of consideration in deciding which policies to set. Clearly, if you've got a significant fleet of company vehicles, you want something that's going to be easy to administer. Attracting staff, it remains the case that people are sort of drawn to what they perceive to be a valuable benefit of having a nice shiny new car every few years. So it can be an important way of attracting the staff you want. So some employers will feel it necessary to offer car schemes and things to employees. And also be concerned with the financing and whether that can have some different sort of tax impacts as we'll go on to see. So looking then at the deductions against business profits, really the first thing from my previous slide. As most people will probably be aware, assets that a business owns are depreciated in the business accounts. Depreciation is not allowable for tax purposes in most cases. There are some exceptions to that. But what happens instead is that tax relief is afforded by way of what we call capital allowances. They don't necessarily fall at the same rate as the depreciation, and that's where the sort of differences arise. And indeed, some assets are simply not eligible for capital allowances. But in relation to cars and vans, normally where it's owned outright, or the car or the van, other commercial vehicle is being acquired on hire purchase, then capital allowances are available, but the rate at which those capital allowances is given comes back once again to the CO2 emissions of those vehicles. So this is for cars, basically where it has emissions below 110 grams per kilometre of CO2, these cars go into the general pool, and you get an 18% annual writing down allowance on that on a reducing balance basis. Prior to April 2018, that emissions threshold was 130 grams per kilometre. So that's, and again, going back a few years further, it was 160 grams per kilometre. So again, we see the revenue and the government basically dictating sort of policy and dictating choices that people make by this CO2 threshold again. So the significance of that really is if you've got a car that's got above 110 grams of CO2 per kilometre, then it goes into a different pool, a special rate pool for tax, and it gets an 8% annual writing down allowance on a reducing balance basis. What does that actually mean in practice? Is it means, if you look at the context at the bottom of that, for the cost of that car, if it's gone into the 18% pool, it will take your business 7 years to get 75% of the relief for that cost. If it's gone into the 8% pool, it will take 17 years to get 75% relief for that cost. And this is all sort of one big pool of assets. It's not a separate pool that will mean that if you dispose of it after 3 years, that you'll then suddenly get the rest of it. It doesn't work that way. It's a pool that remains there and is pooled with lots of other different assets, depending on which whether they go into the 18% pool or the 8% pool. So that has you will get the relief either way, but it's the timing of it, and therefore that has cash flow implications for the business, and of course it can be quite different to the timing of the depreciation as it's charged in the accounts. Ultra low emission vehicles, which is now defined from April 2018 as those which have emissions of under 50 grams per kilometre of CO2, can qualify for 100% first year allowance. So again, that Tesla that we were talking about earlier, if you're a company and you buy one of those, obviously it's got zero CO2 emissions at the tailpipe. Your business is actually going to, if it chooses to claim this 100% first year allowance, and would be able to write off 100% of the cost of that car against tax in year one. Possibly at the point at which you sell it and some money comes back in, some of that might get clawed back. But again, we come down to the cash flow implications. You've had a cash flow benefit there if you can expense the full value of that car in year one. Commercial vehicles, not normally subject to these emission thresholds. So basically they just go into the 18% pool. And indeed for vans and other commercial vehicles, you can potentially claim the annual investment allowance, which is effectively 100% first year allowance, subject to the thresholds for your business. So all businesses have a sort of £200,000 per annum on which they can claim the annual investment allowance. Where you're part of a group, that has to be sort of shared around the group. And of course, it doesn't just apply to cars. It's all the sort of assets that you're acquiring in a particular year. So commercial vehicles, not subject to the same restrictions as cars with higher emissions in particular. So that's the deductions for the sort of capital cost if you're acquiring a car outright or acquiring it through a hire purchase agreement. Of course, many businesses will prefer to lease a car rather than to own it. And the cost to the business of leasing that car is again, is tax deductible. But once again, we see this CO2 threshold of 110 grams per kilometre come in. And basically all that does is if you acquire a car, and this again applies from April 2018 at that 110 grams per kilometre level, prior to that was 130. So all that does is it's a straight 15% restriction where it applies. So really, if you lease a car for £1,000 and it's above that threshold, £150 of that won't be tax deductible, but the other 85% will. Maintenance and running costs, which are often included in a lease, are not subject to that 15% restriction. So if you're working out your restriction for your business, you need to make sure that you identify the separate elements of the total sort of lease and maintenance package and treat it accordingly. So that's leasing really. If you're running a business as a sole trader, or indeed you're a partner, and you're concerned with your own vehicle really that you're running, then it's a slightly different regime that applies. I mean, again, most of the stuff that we've just talked about is still in point, except that you have to make adjustments for private and business use. So what that really means is if 40% of your mileage is business mileage and 60% is private usage, you will get tax relief on the 40% that's business usage, but you won't get any tax relief for the private use. Again, there's record keeping requirements for that, and the revenue are known to check that. So you do need to sort of keep a track on the miles that you're doing, and indeed the percentage of that that's business, and make those adjustments go through on your sort of tax return basically each year. Moving briefly on to VAT, I'm not going to say a huge amount about VAT, but there are obviously quite a few VAT considerations in relation to vehicles, and these include, can I recover the VAT on the car that I've just purchased? The answer to that is yes, you can, but only if it's used for business use only. So if it's available for private use as well for an employee or a director, then no, your business won't be able to recover all of the VAT on that. For leases, we've obviously just talked about the restriction that applies for income tax and corporation tax where a vehicle's leased. The cost of the lease will attract VAT as well, but as a business, you're able to recover 50% of that VAT where that vehicle is used for private use. 100% of it can be recovered, of course, if it's only used for business purposes. VAT recovery in full is usually possible on commercial vehicles. There's also VAT on fuel, and there's various sort of schemes for accounting for VAT on fuel, such as it relates to private and business usage. And full VAT recovery is normally possible on maintenance, servicing costs, etc. even if the car is used for private use as well as the business part. Any irrecoverable VAT, of course, is ordinarily deductible for corporation tax or income tax purposes. So that's all I'm going to say about VAT. I mentioned also that employers pay Class 1A national insurance contributions on the value of the benefits in kind. So I just wanted to come back to my earlier example, really, just to demonstrate quite simply, really, what that means. Again, I haven't quite managed to update all the references in this slide to 2017-18, so that should actually read 2018-19. But you see, we had those benefit in kind rates for my three different variants of the Gulf: 30%, 28%, and 13%. The benefit in kind, just a reminder there. Well, employer Class 1A national insurance is chargeable at 13.8% on those benefit in kind. And so you can see that actually the business itself, in addition to the employee's income tax position, for the GTI there, there's roughly £100 a month, £1,253 that will be payable via the P11D system. Directly by the business on providing that benefit to its employee. But again, the GTE, as you would expect, because of its lower emissions and therefore a lower benefit in kind, we come down to a much lower amount of employer Class 1A national insurance. So there's obviously savings to the employee on the income tax side, also then the savings to the business. We've also talked about the fact that with these lower emissions, you might then get accelerated capital allowances, etc., on the cost of buying the car. So it all feeds into the same thing. The more fuel efficient and less polluting the vehicle, the better the tax regime. I said I'd touch on salary sacrifice arrangements. This is just really to make you aware of some fairly new rules that came in April 17 last year. It was pretty common, really, in many places for people to be offered either to have a company car or salary, or sort of car allowance, perhaps. These rules sort of mean that you've got to take a degree of care over that, because what they actually say is, because you might say, well, I'll forego some salary and I'll have a really tax efficient car because actually overall my tax position will be much better then. But following these rule changes, which were described as optional remuneration arrangements, you can basically be stung so that you still effectively pay tax on the salary foregone if that's higher than the tax on the benefit in kind. So really what these rules are aimed at is where you're given a choice, the revenue sort of say, well, we're still going to tax you on the salary that's foregone. So you kind of need to, if you're taking on a new employee, for example, you kind of need to be agreeing it with them before they start as to the fact that they're going to have a company car. And they're not able to sort of dip in and dip out of that, really. So there's still some sort of uncertainty, really. We talked about type A and type B there. I mean, type A, I think, is relatively clear. If you're sacrificing current salary in favour of a benefit, a car in this example, you can potentially be caught. But also, if you're sort of foregoing future salary or earnings, well, it's potentially wider, and we haven't really got much revenue guidance on what that means. But the point is really, you need to decide that you're going to give employees one or the other, and they can't really sort of dip in and out and change. So just one to be aware of and to actually take advice on if you're having sort of negotiations with an employee, just to make sure you don't fall foul of it. These rules, by the way, don't apply if the CO2 emissions of the vehicle are less than, I believe it's still 75 grams per kilometre. I'm not aware that that's come down to 50, but worth checking, really. So, i.e., if you're taking a very fuel efficient car, you actually can step outside of these arrangements, so you can still do the sort of typical salary sacrifice type arrangement with that flexibility to change it from time to time. Those particular rules, by the way, don't just apply to cars; they apply to a range of benefit in kind. So it's one to be aware of. Moving on once again, not too many more slides to go now. Pool vehicles. So this is effectively where a business has one or a number of vehicles that are available to multiple employees to use. And where you have a genuine pool vehicle, it is exempt from all this sort of benefit in kind stuff that we've talked about, and that's cars and vans where it's being used by employees. So it can be quite attractive to sort of try and say that you've got a pool vehicle, because obviously there's no benefit in kind then. And indeed, I've seen cases of some quite luxury cars that the business claims are pool vehicles, but it's one of the things that the revenue are going to look at. So if you do want to have a pool vehicle, you do need to meet the requirements of it. Otherwise, you can end up, if the revenue come in and run an inspection and they find that you haven't met the requirements for the pool vehicles, they will come after you as the employer for some quite significant tax liabilities that can arise on those benefits in kind. And indeed, going back a number of years, once you factor in it, penalties and interest and things, you can be looking at some quite significant sums of money if you get this wrong. So basically, if you want to have a pool vehicle, all of the requirements listed on the slide there need to be met. So it must be available to and actually used by more than one employee, i.e. it can't just be, say, the director's car that only he uses, even if it's just for business. It does need to be used by more than one employee. And it needs to be available to each employee by reason of their employment, which, obviously if it's being used for business purposes, then it will do. It should not ordinarily be used by one person to the exclusion of others, going back to my point about the director there. And any private use, it is acceptable to have a little bit of private use, but it needs to be incidental to the business use. So an example of that might be, for example, an employee has got to do a business trip the next day. They've got an early start, so the employer will say to them, will you take the pool vehicle and take it home with you tonight so that you can go straight off on your business journey tomorrow. But you do need to watch this sort of rule of thumb, really, which says that the vehicle should not normally be kept at or near the home of an employee overnight. And there's a sort of 60% rule of thumb there, so you've got to stay the right side of that. Contemporaneous record keeping is clearly key, really, because as I've said, it is more likely that the revenue will look at this, especially if you do have some nicer vehicles that are supposedly pool cars. So make sure the record keeping is there that backs up how that vehicle is actually being used. Keep that register of how and when it's being used, where it's gone, etc. Failure to comply, the normal car ban benefit in kind rules plus the fuel benefit in kind, because it will automatically then be deemed to have been used for private purposes, all sorts of apply, and it can be very costly to get this wrong. Moving on once again, just wanted to look really about, if you are offered an employer-provided car, a company car, versus using your own car, what's the right solution there, or what's the right solution for you as a business owner? Indeed, if you own a company, should you have your car through your company and suffer the benefit in kind charges, or do you just own it personally? There's not necessarily a one-size-fits-all for this one. In fact, there isn't a one-size-fits-all. Obviously, if you're the company owner, you will need to assess both sides. What's the whole cost? What are the costs to the company? What are the tax costs to you as an individual? And you can compare having a company car with a non-company car and do some maths on that and actually work out what works out to be best. There aren't really any general rules around that as to what will come out to be the best situation. Certainly it's true to say that historically luxury vehicles were often more tax efficient in personal ownership, i.e. outside of a company. But these rules that we've talked about with the benefit in kind for electric vehicles and hybrid vehicles really is changing that landscape. So I think in many cases now, actually, if you are looking at these tax efficient vehicles, it can be more tax advantageous to have them through the company than to basically own and run them personally, when you factor in all the sort of costs of the financing and everything, when you look at the full picture, not just the tax. If you're an individual and it's just your employer that's offering you a company car or not, then of course you're not so concerned with what the company position is. You just really need to look at the cost for you as an individual in terms of the tax cost of having that company car versus the cost of running it privately. So it's a slightly simpler sort of position. And in assessing those, one of the things that's worth taking into account is the authorised mileage payments. So these are, I talked previously about the mileage rates that can be used where a company car is provided, an employer provided car is there. These mileage rates that are listed here are the maximum amounts that can be paid tax-free where an employee or a director uses their own car for business purposes. So if an employee drives 100 miles for business, their employer can pay them £45 for that journey, and that's free of any tax for the employee for the first 10,000 business miles in a year. If you do go above the 10,000, which the majority of people probably won't if they're using their own vehicle, it drops to 25p a mile. If you take passengers, you can claim an extra 5p per mile as a passenger supplement, and that's per passenger. So if you've got 2 passengers in your car for a particular journey, your employer has the ability to pay you an additional 10p per mile for that. So these are the maximum amounts basically that an employer can choose to pay, and for it to be tax-free. In many cases, you'll find that employers choose to pay a slightly lower rate, in which case employees are actually able to make a claim, a personal tax sort of claim, to have tax relief on the difference. If you do a self-assessment tax return, obviously that's quite easy to do that way, but otherwise there are means for making these claims. So basically, own car versus private car, you just really have to, own car versus company car, it's all about doing the maths really and deciding what's the right position for you. So second question then really, given all that we've just talked about, I just wondered whether we might see a change of position. So the second question is, do you anticipate that you or your business will run electric only or hybrid electric vehicles within the next 3 years? So if I could just get your answers to that, that would be great. We're just counting. And I think we're nearly there now. One or two still to come in by the looks of things. But basically that's looking like roughly 90% of you are now saying yes, within the next 3 years you think you will run electric or hybrid electric vehicles. So back at the start we said it was 50-50. Given the changing landscape, it's quite clear the direction of travel, and most of you out there are thinking that actually, we are going to move to these more or these less polluting vehicles in the future. So just to sum up then, really, very quickly, my main point has been where you're looking at company vehicles and things, look at the whole life. If you're entering to a 3-year lease, a 4-year lease for a vehicle, actually look at the cost of that over the 4 years ahead and work out what it's going to cost. And there can be some very big differences between different derivatives of the same car effectively. So careful choice, yes, can save thousands of pounds. The fuel benefit for private use of company cars is very rarely worthwhile taking. Do consider pool vehicles where the circumstances permit, because obviously there's no income tax consequences to individuals of that. But just always bear in mind that the cost of failure to operate all these rules correctly can be quite high if the revenue pick it up and look to go back a number of years, as they're entitled to do, to correct things. And if they then factor in, well, they'll always factor in interest, but penalties on top as well. It can be costly to get it wrong. So record keeping is important, and do ensure that your arrangements as an employer are robust and monitored. So that's it really from me. I mean, obviously this is we've gone into a reasonable bit of detail on some of these things, but it is a webinar that's of a general nature. So I do recommend that you take specific advice for any sort of arrangements that you're considering if you're at all unsure. So thank you very much for listening. And I think since we're kind of running to the end of our time for this now, we'll wrap it up. And there are 1 or 2 questions, but I'll follow those up separately, individually. Thank you very much.